Alright, friends, gather round. Welcome back to Boss Economics World, the only place that gives you the director's cut of the global economic dumpster fire. Today, we're peeling back the curtain on a little piece of theater that played out on Fox News, starring none other than the Chicago Fed president, Mr. Austin Goolsbee. The date is October 3, 2025. The US government has once again managed to trip over its own shoelaces and into a shutdown. The lights are off at the Bureau of Labor Statistics. The folks who are supposed to be counting the beans, or in this case, the jobs, are at home, probably stress-watching reruns of The Office. And into this data vacuum steps Mr. Goolsbee, a beacon of calm in a sea of chaos. He looks into the camera, smooth as a freshly printed dollar bill, and tells us not to worry our pretty little heads. Based on some new data produced by his staff, we'll get to that magical mystery data in a minute, the labor market remains stable. He thinks the underlying economy is growing pretty solidly. Stable. Pretty solidly. Folks, in the language of central bankers, these words are masterpieces of illusion. This isn't an economic assessment, it's a bedside whisper to a patient in critical condition. His condition is stable, says the doctor, which really means he's not actively getting worse at this precise second. He has a solid constitution, the doctor adds, as the patient's family looks on, desperate for any shred of good news. What Goolsbee and the Fed are doing is a classic magic trick. It's called misdirection. They want you to look at the steadiness of the labor market so you don't look at the absolute five-alarm fire raging in other parts of the economy, the deep, philosophical cracks forming within the Federal Reserve itself, and the terrifying reality of what their alternative data really means. So today, we're going to do what we do best. We're going to take this one point, the seemingly innocuous interview, and expand it to the surface, exposing the massive, systemic issues lurking just beneath. Buckle up. Let's start with the most glaringly absurd part of this whole story, the data. The official government statisticians are locked out. So, where is the Chicago Fed getting its numbers? Goolsbee vaguely mentions a Chicago Fed analysis. What is that? Is it a focus group? Are they reading tea leaves? Scrying Gov't entrals? It's actually something much more modern, and frankly, more dystopian. They're turning to alternative data. This is the new holy grail for Wall Street and now, apparently, for our central bankers. This includes things like 1. Payroll processing data from private companies, think ADP, Gov't. They see in real time who is getting hired and fired among their clients. 2. Credit and debit card spending data, Visa, MasterCard, and American Express know exactly what you're buying, where, and how much. They can see consumer spending trends before any government agency can. 3. Location data from mobile phones, anonymized, of course, wink, wink. Tech companies can track foot traffic to factories, shopping malls, and offices to gauge economic activity. 4. Job posting data scraped from websites, tracking sites like Indeed and LinkedIn to see if hiring appetite is rising or falling. On the surface, this sounds innovative. It's big data to the rescue. But let's be real. This is the Fed, the institution that steers a $28 trillion economy, admitting that with the official dashboard turned off, they're basically plugging an uncertified, third-party dongle into the system and hoping it doesn't install a virus. This vibes-based economics has three massive problems. First, it's biased. The data from ADP primarily covers their corporate clients. It misses huge swaths of the gig economy, small businesses that do payroll by hand, and undocumented labor. Credit card data overrepresents higher-income households who use plastic for everything, while underrepresenting lower-income families who rely on cash. This isn't a snapshot of the economy, it's a selfie taken from the first-class lounge. Second, it's unauditable and proprietary. We, the public, can't check their work. It's a black box. The Chicago Fed can say, our model suggests the unemployment rate was likely unchanged, and we just have to take their word for it. This erodes the last vestiges of public trust in an institution whose primary currency is credibility. Third, it creates a dangerous precedent. By legitimizing this approach during a shutdown, the Fed signals that the messy, slow, but accountable work of public statistics can be replaced by sleek, fast, and opaque private data. It's the Uberization of economic policy. Why wait for the official taxi when you can get a ride right now from a guy whose background you can't really verify? This isn't just a technical issue. It's a philosophical one. It reflects a world where we trust corporate data streams more than public institutions, a world where the real economy is the one that can be measured by a fintech app. Now, let's talk about the substance of Goolsbee's claim that the labor market is stable. Even if we accept his magical data, this word is doing some heavy lifting. What does a stable labor market look like in late 2025? It's a beautifully constructed facade, a Potemkin village of economic health. Behind it lies a deeply fractured and unequal reality, the K-shaped recovery on steroids. Let's look at some plausible numbers that Goolsbee's rosy picture conveniently ignores. Before the shutdown, the last official unemployment rate was, let's say, 4.1%. Looks great, right? Almost historic lows. But the devil is in the details they don't talk about on cable news. The U6 rate, this is the real unemployment rate, the one that includes the officially unemployed, plus all marginally attached workers and those employed part-time for economic reasons. That number isn't 4.1%. It's hovering around 7.9%. That's millions of people who are underemployed, patching together gig work, or who have given up looking altogether. That's not stability, that's desperation hidden by statistical tricks. Labor force participation, the participation rate, especially for prime-age men, has been stubbornly below pre-pandemic levels. We have a growing cohort of people who have simply checked out of the formal economy. They aren't counted as unemployed. They've just vanished from the ledger. The great divergence, the stability is concentrated at the top. The tech sector, despite some high-profile layoffs in 2023 to 2024, has rebounded. Demand for AI specialists, cybersecurity experts, and green energy engineers is through the roof. Their wages are climbing. But for the other arm of the K? It's a bloodbath. Example 1, the AI disruption. The last year has seen a quiet revolution in administrative and back-office work. Companies like JP Morgan Chase and Accenture have deployed AI agents that can now handle 60% of customer service inquiries, draft reports, and manage scheduling. This has led to a wave of efficiency layoffs, a polite term for replacing a $55,000 a year office manager with a $5,000 a year software license. These jobs aren't coming back. Example 2, the commercial real estate collapse. The persistence of hybrid work has cratered the office real estate market. This doesn't just hurt developers. It decimates the entire ecosystem around it, the cleaners, the security guards, the deli that sold sandwiches to office workers. For every empty floor in a Manhattan skyscraper, there are a dozen low-wage service jobs that have evaporated. Example 3, the consumer squeeze. While Goolsbee talks about a solidly growing economy, total U.S. credit card debt has just surpassed a record $1.3 trillion. Delinquency rates, particularly for auto loans and credit cards, are at a 15-year high. This isn't a sign of solid growth. It's a sign that millions of families are using debt to plug the gap between stagnant wages and an inflation rate that, while lower than its 2022 peak, has remained stubbornly sticky. Core PCE, the Fed's preferred inflation gauge, has been stuck at 3.2% for 3 straight months. Headline CPI recently flared up to 3.8% because of another supply chain disruption in the Middle East. People are paying more for gas, groceries, and rent, and their wages aren't keeping up. So, when Goolsbee says the labor market is stable, he means the top 30% are doing just fine, which is enough to keep the headline number looking pretty. For everyone else, stable means stably running in place, or stably sinking into debt. This brings us to the core drama hinted at in the report, the deep disagreement within the Fed itself. The projections show 2 more rate cuts in 2025, but this is just a median forecast. It hides a vicious internal battle. This isn't just an academic debate, it's a war over the future of your mortgage rate, your job security, and the value of your savings. In one corner, we have the doves. Goolsbee is a charter member of this club. They look at the slowing GDP growth, projected to be a pathetic 1.1% for Q3, they see the rising credit card delinquencies, and they are terrified of tipping the economy into a recession. Their argument is, inflation is coming down from 9%, it's now in the 3s. The war is mostly won. If we keep rates this high, we're going to break something. It's time to declare victory and start cutting to support the stable labor market before it cracks. They believe the risk of a recession is now greater than the risk of inflation. In the other corner, we have the hawks. Think of figures like Minneapolis Fed President Neel Kashkari. They are haunted by the ghost of Arthur Burns, the Fed chair who let inflation get out of control in the 1970s. They look at the 3.2% core PCE and say, this is not 2%. It's over 50% higher than our target. They see the wage growth in the service sector and the still strong consumer spending, fueled by debt, and believe that inflation is not vanquished, it's just sleeping. Their argument is, if we cut rates now, inflation will come roaring back. We have to keep our foot on the brake until we are absolutely certain the beast is dead. A short, painful recession now is better than a decade of stagflation later. And in the middle, you have Chairman Powell, the ultimate tightrope walker, trying to balance these 2 warring factions while being yelled at by politicians. This disagreement is so profound because the tools they have are so blunt. The Fed funds rate is not a scalpel, it's a sledgehammer. And they're trying to perform brain surgery with it, in the dark, using a map drawn on a napkin by a tech company. The real problem is that both sides might be right, and both might be wrong. The economy is now so weird, so distorted by the pandemic, by trillions in stimulus, by geopolitical shifts, and by technological disruption, that the old models don't work. We might have structural inflation that can't be tamed by high interest rates without causing a full-blown depression. We might have a labor market that looks strong on the surface but is hollowed out underneath. So let's bring it all back to Goolsbee's calm, reassuring words. What he's doing is managing sentiment. He's a storyteller, and the story he's telling is one of competence and control in a world that is clearly out of control. The shutdown is not some random background event. It is the symptom of the disease. It's the political paralysis of a deeply divided nation that has abdicated all responsibility for economic management to an unelected committee of economists, the Federal The Fed was never designed to be the only game in town. Monetary policy cannot fix a broken supply chain, it cannot retrain a worker whose job was replaced by AI, and it cannot solve deep-seated inequality. All it can do is make money cheaper or more expensive, hoping it pushes people in the right direction. And now, even that one tool is failing. They are flying blind, using corporate alternative data that reflects a sliver of the economy, all while fighting amongst themselves about whether to hit the gas or the brake. So what does this mean for you, the professional in the finance industry or the ordinary person just trying to make sense of it all? 1. Trust nothing. Verify everything. Distrust the headline numbers. Dig deeper. Look at the U6 rate, not the U3. Look at credit card delinquency rates, not just retail sales. The official narrative is designed to keep you calm. The real story is in the details. 2. The K-shape is the new reality. Understand where you sit on that K. If you're in a high-demand sector, your prospects are good. If you're in a sector vulnerable to AI, automation, or a consumer pullback, you need to be building a lifeboat. The idea of a single, monolithic economy is dead. There are now multiple economies operating in parallel. 3. Prepare for volatility. The Fed's internal conflict means policy is going to be unpredictable. They might hold rates high, triggering a recession. They might panic and cut rates, causing inflation to spike again. This is not a time for complacency. The soft landing they've been promising for 3 years is still just a flight of fancy. The turbulence is real. When a Fed president goes on TV during a government shutdown to tell you the economy is solid based on secret data, he's not informing you. He's managing you. He's treating the economy not as a system to be understood, but as a patient to be sedated. The real data isn't in a Chicago Fed spreadsheet. It's in your grocery bill. It's in your credit card statement. It's in the job security of your friends and neighbors. And right now, that data is telling a very, very different story. This is Boss Economics World. Stay cynical. Stay informed. I'll see you next time.